Welcome back. This section is on moral hazard and some of the issues that are associated with moral hazards. And we're going to look at prices in terms of health insurance. And then finally we're going to end with utilization management, which are techniques that can control for moral hazard. So let's go ahead and get started. So what is moral hazard and where did it originate from? Moral hazard originated from casualty insurance or property insurance. So if your house is insured against damages, you may have faulty wiring that causes the house to burn down, or you may have the house maybe struck by lightning, which starts a fire. Or finally, the one that we're talking about, moral hazard, that refers to where the owner destroys the house to collect the insurance. This terminology has been carried over to health insurance and assumes that individuals with a health insurance policy are going to use more health services. The difference in the two applications of using moral hazard, when we talk about the house and someone burns the house down, that's immoral or illegal, versus the health insurance example, it's just more of a question of the law of demand, and if they have insurance, they're more apt to use health services. So let's continue on. There's two types of moral hazard: ex-ante, which is before, and ex-post, which is after. So let's talk a little bit about ex-ante. So if a person doesn't have insurance, let's use car insurance, boat insurance, they may be very cautious because they know if they get in an accident or something happens, they have to pay. And then once they get insurance, then they start, flying around and going real fast because they know if they get in an accident, the insurance company is going to pay. Now let's take a look at an example for ex-post or after. The most common example used is that a person that has insurance or health insurance will probably go, or in a lot of cases goes to the doctor more than they need to. If you're watching this conclusion video, you've obviously gone through the PowerPoint presentations and you've read the chapters associated with this section. Finally, if you've been assigned the power of 3 this week, pay particular attention to moral hazard, price elasticity, and coinsurance. Price elasticity is what your favorite health economist Rafat would tell you is a way of qualifying the effect of a change in price on the change in the quantity demanded. If you need a refresher on price elasticity, I cut out a small segment of a Khan Academy video. If you recently finished up health economics, you can go ahead and fast forward to the next section. If you're not familiar with Khan Academy, let me say it is an excellent reference tool. The website provides hundreds of tutorials on a variety of subjects and has close to 2 million subscribers. If you haven't seen it, I strongly recommend you take a look at it.
What we're going to think about in this video is elasticity of demand. Elasticity of demand. And what this is a measure of how does the quantity demanded change given a change in price, or how does a change in price impact the quantity demanded. So change in price, change in price, impact quantity. I want to be careful here. Quantity demanded. When you talk about demand, you're talking about the whole curve. Quantity demanded is a specific quantity. Quantity demanded. And the way that we as economists, I'm not really an economist, but since we're doing economics, we can pretend to be economists. The way that economists measure this is they measure it as a percent change in quantity over a percent over the percent change in price. And the reason why they do this, as opposed to just say change in quantity over change in price, is because if you did change in quantity over change in price, you would have a number that's specific to the units you're using. So it would depend on whether you're doing quantity in terms of per hour or per week or per year. And so you would have different numbers based on the time frame or the units that you might use. But when you use a percentage, it is a unitless number, because a percentage, you're taking a change in some quantity divided by that quantity. So the units themselves actually cancel out. And the reason why it's called elasticity, this might make some sense to you, or the reason why I like to think it's called elasticity is I imagine something that's elastic, like an elastic band or a rubber band. And in the rubber band, if you pull it, depending if something, so let's say that this one is inelastic. So if you pull, you're not going to be able to pull it much. It's going to be fairly stiff. It's not going to stretch a lot. While if something is elastic, for a given amount of force, so this is for a given amount of force, you're not able to pull it much. And if something is elastic, maybe for the same amount of force, you're going to be able to pull it a lot. So this right over here is elastic. And so the analogy maybe might make a little bit sense relative to price and demand. Something is elastic. So let me write this down. Elastic. So let me write very elastic. Very elastic if a given change in price, given price change, you have, and especially we'll talk about percentages in a little bit, but a given change in price, you have a large change in demand, so large percentage change. And let me just speak in terms of percentage. Given a percentage change in P, you end up having a large percentage change in Q. That would be very elastic. So you could imagine the P is like the force, and the Q, the quantity demanded, is how far the thing can get stretched apart. And that's why we would call this very elastic, just like a very elastic rubber band. And if something is very inelastic, if given a percent change in P, you have a small percent change in Q. So just like a rubber band, for a given amount of force, if you're not able to pull it much at all, then it's inelastic. If you're able to pull it a lot, it's elastic. Same thing with price and quantity.
I think Salman Khan is an excellent instructor. So let's talk a little bit about how to measure risk and how to measure moral hazard. Let's take a look at the example in your textbook. Basically, moral hazard is nothing more than the law of demand. In this example, $60 represents the cost of a doctor's visit. But what happens when you introduce co-insurance and you lower the out-of-pocket expense for an individual? So $60 is the usual cost, but now all the individual has to pay when they have insurance is $20 out of pocket. When an individual has to pay $60, they're more apt to take the doctor's advice and kind of take a wait-and-see attitude. But once you introduce a copay, then if you look at the chart up there, you can see that the office visits double. So $20, then they paid another $20. So what happened is they're more apt to go to the doctor more often and go back. And this is precisely what is meant by moral hazard. The copay establishes moral hazard in the healthcare industry. So at $60, the patient is only going to go once. But now at a $20 copay, they pay once, they pay again, and they're up to $40, which is less than the $60 originally. But what happens is now the doctor has been paid twice. The doctor's been paid for one visit, a second visit. They're up to $120. So consumption increases with the use of copays. The triangle Z is a loss associated with this extra consumption. It reflects the expenditure made on behalf of the insured over and above the value of the service or above the customer demand curve. There are numerous studies presented in the moral hazard chapter, but let me say that overall the findings are pretty consistent, that there is moderate price sensitivity in the overall use of health services. The more an individual has to pay, the less health services they're going to consume. They pay less, they tend to consume more health services. Worth noting is the RAND health insurance experiment. It'll come up over and over again in this chapter, but it provides an insight into price responsiveness of consumers. This study is particularly useful because it's rather large and it avoided adverse selection. The RAND study avoided adverse selection by randomly assigning families to health care insurance plans. Think back to our earlier discussion about adverse selection. Because when you're dealing with insurance, most of the time you're going to have a confounder, and what I'm getting at is the group with coverage is likely to acquire insurance because the group members are more likely to use health services. That's why the RAND studies are so important. It's because they randomly assigned families to different healthcare plans. Let's take a look at one of the slides that was in the presentation, or in the PowerPoint presentation, that confirms this. If you look at the far right-hand column, which says medical expenses, you can see when the families didn't have to pay anything, you could see the cost at $3,164, and then when they had to pay up to 95% rate, the overall expenditure dropped down to $2,174. So consistently getting lower as you move down. So let's round out our discussion about elasticity. Take a look at ambulatory, and if you look at 0 to 25, it's 0.17, and 25 to 95%, it's 0.31. And so the difference is, the reason the 25 to 95 is higher is that as the customer has to pay more, the percent of services that they use is going to be less. So 31% less services used than compared to the other one. But then take a look at the hospital. That tends to be more inelastic. If somebody has an emergency, they're going to go to the hospital. So you can see the difference there. It's a lot closer at 0.17 and 0.14 negative. Let's touch on moral hazard one more time before we close out this particular section, and we'll use an example that's been in the news quite a bit, or from years back when the banks failed. Think about Bank of America and some of the other banks. The moral hazard associated with financial organizations was amplified for a number of reasons. Primarily, the large banks were able to shift the risk over to the government, Fannie Mae and Freddie Mac, and so that reduced their risk, which made them give more loans that were not as secure and take greater risks, and people tended to default on it. The other thing is that consumers overall, they could get loans, put very little down, little or nothing down, and if they defaulted on the loan, well, so be it, because they had no skin in the game. They didn't put 20% in. They had no investment into it. They bought a house, they couldn't make the payments, and the house got foreclosed. Another issue in terms of moral hazard was that many people felt that the banks were too large to fail. And so who got caught holding the bag? The U.S. taxpayers, because that's who was backed Fannie Mae and Freddie Mac. Some final thoughts before closing out this moral hazard chapter. One thing that's worth noting and worth looking at is go to the back of the chapter summary. It takes the RAND report and kind of breaks it down, for particular services. For example, one that's interesting that you might want to go through is the one with the greatest price sensitivity is mental health services. It's a huge difference compared to the other services out there. But you could read through that and just get a feel for prescription drugs, nursing homes, etc. And then also I'd like to talk a little bit about elasticity. Remember, healthcare is a different animal, and it's affected differently than other goods and services. Because price elasticity, it's more inelastic, meaning that you've got a problem, you've severed a limb, or you've broken an arm, you're going to go to the hospital regardless. Versus if the price, regardless of what the costs are. So if the price of a TV goes up, you may do without a TV, or you may do without a new car, but you're not going to do without having an emergency visit. So how do we control and what do we do to handle some of the moral hazards involved with healthcare? And that's where utilization management comes into play. So let's cover that real quickly. Utilization management. The book refers to utilization management as any clinical restriction on utilization designed to approve or disapprove care based on clinical necessity. They don't block the patient from obtaining the care. They simply say that the insurer is not liable for the cost of the service. That is ultimately what the utilization management is, and there are several procedures and several techniques to control the utilization of service. So if this is your week to do the power of 3, just go ahead and pick 3 utilization management techniques from the book and use some digital images and talk about them. So if you got the older book, that's going to be on page 118. If you've got the newer book, take a look at page 158. Pick 3 images that are associated with, for example, pre-admission or gatekeeper, and talk about that in your presentation. Power of 3 gives you an opportunity to step outside the textbook and the PowerPoint presentations and share with the class some of the latest, greatest industry information that's out there. Here I used an article that just came out on May 15th. How does the gate tie into the article I just talked about? Well, an X-ray technician can be a key player in promoting high-value, cost-conscious care. And how can that be done? Here's an example that the physician used in the paper, and it also gives you an indication of another utilization management tool. So here's what they're doing. At this particular hospital, the X-ray technicians are reviewing the clinical scenario of each patient on the next day's schedule. The tech had noticed that there had already been an abdominal CT done on a particular patient. So he called the physician and said, hey, do you want another one done? And he was able to save duplication of another CT. This technique takes advantage of the radiologist's and the X-ray technician's expertise in the field. Another example was that the X-ray technician saw that there was an upcoming CT for a chest scan, and he noted in the chart that there was some swelling in the neck and asked if he wanted to add a CT on the neck. Again, a way of reducing costs and saving money, because they're doing one CT, they might as well do another one and only be charged once. Utilization management is a buzz right now. Everybody is trying to control costs. The Affordable Care Act, people are looking at the cost of readmissions back into the hospital, so they're trying to, intervene and stop that. Here's an example of some of the interventions that Blue Cross and Blue Shield are trying to do as far as reducing costs. The whole point is that insurance, the government, everybody involved with paying for healthcare services is trying to hit a bullseye in terms of reducing costs. In closing, I look forward to watching your Power of 3, where you explain some of the latest and greatest techniques for reducing costs, and I'll see you in the next video.